The exchange Mastercard shares up about 3% today after a second quarter profit beat and an uptick in consumer spending activity. But my next guest isn't feeling too bullish on the credit card names. He just downgraded both Mastercard and Visa, saying some clouds could be gathering in the payment space. And he does like one buy now, pay later name, saying upcoming rate cuts could be a positive catalyst for that stock. Joining us for more is Jason Kupferberg, BofA Securities senior payments analyst. Jason, it's great to see you. And listen, if crypto and DeFi couldn't disrupt Visa and Mastercard, I've given up that anything can.
Well, thanks for having me. I would tend to agree. This is certainly not a call about disruption of Visa and Mastercard. This is simply a call that we become a little bit more concerned about the multi-year revenue growth algorithm at both companies after running some detailed scenario analyses of the three different components of their business, feeling like the cash to card conversion cycle that has been going on for decades has still got some steam, but not as much as it once did. And we're also a little bit concerned about potential outcomes of some litigation where there were some unforeseen and unfortunate developments about 6 weeks ago.
So there's nothing macro in here that needs to, because usually you see Visa and Mastercard, you think that's it, throw in the towel on the consumer and the economy, it's over.
We're not throwing in the towel on the consumer or the economy. This is not a call that says, hey, the consumer is going to fall off the cliff in the second half. I mean, it was interesting, though, to note that last week when Visa reported during their earnings call, they did suggest that the lower income cohort has seen a little bit of a slowdown in spending. Mastercard, however, did not call out that same dynamic. So no, our call is not that there's huge risk to near-term estimates. Our call is that there's just going to be a little bit more revenue softness potentially on a multi-year basis than what consensus currently assumes, and the stocks are fully valued at this valuation multiple.
And I think it's important to highlight that, and that they are not, Mastercard especially, is not calling out a slowdown in spend when we see the earnings blow-ups. Every time you turn around, there's a consumer packaged good company or a restaurant name that is just not able to put in the top line or maybe earnings growth they were hoping for, which points to a shifting consumer, maybe one that's fed up with inflation, but not a story of a broader slowdown. So like you said, there's some kind of stock-specific things going on here. What about Affirm, which you're more positive on? What's going on there?
We did upgrade Affirm to buy from neutral yesterday. They are a leading provider of buy now, pay later solutions, so that's primarily in the e-commerce world. We really upgraded the stock for a couple of reasons. Number one, we think that they are going to be able to achieve profitability on a GAAP basis, not adjusting out stock-based compensation or any other types of expense, on a GAAP basis sooner than consensus believes. We think that there's going to be some declines in stock-based compensation. They're really sharpening their pencil on costs here. And the second reason is that a lower interest rate environment, which is obviously what's now priced into the market, should benefit Affirm in the terms of lower funding costs. And the third point I would make is that the stock is down 40% year to date. So we see attractive risk reward here, and we do believe that their earnings report in late August could be a positive catalyst.
Do we go so far as to think of them as somewhat counter-cyclical, meaning that if things do weaken, especially on a low-end consumer, a lot of people thought they'd be the first place to feel the pain, but maybe credit card delinquencies rise and people turn to a service like this?
This can be a backup option as an alternative to a traditional credit card. The terms are much more friendly to the consumer. Think about it. If you're a consumer who's struggling to make ends meet, you want that $200 pair of shoes, you can make 4 payments of $50 each over the next 6 weeks with no interest. That fits your pay cycle much more neatly and is much friendlier to your pocketbook. So we could see some of that. And we also believe that buy now, pay later as a category is going to take share from overall consumer payments on an ongoing basis because the penetration rates to date are still quite low.
Indeed. Jason, thank you so much. It's good to check in with you. We appreciate your time. Jason
You too. Thank you.
Kupferberg, Copper Mountain from BofA.